financial innovation has never been driven by curiosity alone. It has been driven by pressure. Every new tool, every new market, every new instrument emerged, not because humans sought complexity, but because existing systems failed to cope with risk scale or ambition. Finance evolves when the old tools break. The earliest financial innovations were defensive. Credit insurance and partnership structures arose to survive uncertainty. Merchants did not invent loans to speculate. They invented them to move goods across distance and time. Risk-sharing preceded profit-seeking. Before markets became engines of growth, they were shields against ruin. As trade expanded, so did the need for abstraction. Money itself was an innovation, a way to store trust and transmit value beyond barter. But money alone was insufficient. Commerce demanded promises, promises to pay later promises, to deliver promises to insure against loss. Each promise required a structure to enforce it. Ledgers, contracts, and courts followed. Finance grew alongside institutions because innovation without enforcement is merely hope. The medieval period introduced a profound shift, the separation of ownership and control. Joint stock companies allowed ventures too large for any single merchant to be financed collectively. Shares transformed risk into divisible units. Failure became survivable. This innovation did more than raise capital. It changed psychology. Investors no longer feared total ruin. They feared volatility. Markets were born from that distinction. Every major financial advance followed the same arc. A genuine economic need produced a useful tool. The tool spread. Profit incentives expanded its use beyond its original purpose. Complexity increased. Risks accumulated invisibly. Crisis followed. Regulation lagged. Then innovation resumed elsewhere. The rise of banking illustrates this cycle vividly. Early banks existed to safeguard deposits and facilitate trade. Over time, they discovered leverage. Deposits could be lent. Reserves could be minimized. Credit could be multiplied. Banking innovation fueled growth, but also fragility. Each crisis forced adaptation. Central banks deposit insurance capital requirements. Innovation and regulation danced endlessly, each responding to the other's excesses. The 19th and early 20th centuries accelerated this process. Industrialization demanded capital at unprecedented scale. Bonds financed railroads. Stock markets expanded. Derivatives multiplied. Financial instruments became increasingly detached from physical production. Finance stopped merely supporting the economy. It began shaping it. The 20th century institutionalized innovation. Governments entered markets as borrowers, insurers, and regulators. War bonds mobilized entire populations. Central banking evolved from passive guardian to active manager. Monetary tools multiplied. Inflation targeting open market operations and lender of last resort facilities became innovations of policy rather than product. Yet the most transformative innovations often emerged in the shadows. Securitization turned illiquid assets into tradable securities. Credit default swaps transformed credit risk into market risk. These tools promised dispersion of danger. In practice, they redistributed it opaquely. Risk did not disappear. It migrated. The late 20th century celebrated financial innovation as progress itself. Complexity was equated with sophistication. Markets expanded faster than understanding. Models replaced judgment. Correlation replaced causality. The assumption hardened that innovation reduced risk rather than reshaped it. Crises shattered that illusion. The collapse of long-term capital management revealed model fragility. The 2008 financial crisis exposed how innovation without accountability amplifies systemic risk. Tools designed to spread risk concentrated it instead. Markets that promised liquidity froze simultaneously. History reveals a brutal pattern. Financial innovation almost always works until it works too well. By smoothing friction, it encourages leverage. By disguising risk, it invites excess. By abstracting loss, it delays recognition. Yet innovation never stops. After each crisis, it reappears under new names. Shadow banking becomes fintech. Leverage becomes liquidity transformation. Derivatives become algorithms. The forms change. The logic persists. The digital age represents the latest chapter. Electronic trading accelerated markets beyond human reaction. Cryptography challenged centralized trust. Decentralized finance promised systems without intermediaries. Each innovation carries familiar claims: efficiency, inclusion, resilience. Each faces familiar questions: governance, stability, accountability. What history teaches is not that innovation is dangerous, but that it is incomplete without institutional adaptation. Tools outrun rules. Markets outrun memory. Every generation believes its innovations are different. Every generation relearns the same lesson. Financial innovation is therefore not linear progress. It is cyclical tension between ingenuity and restraint. Its greatest achievements expand opportunity. Its greatest failures expose fragility. The difference lies not in the tool itself, but in the context that surrounds it. Standing across centuries of innovation, one sees finance not as a machine, perfected, but as an experiment continuously rewritten under pressure. Each new tool reflects what societies fear most at that moment: uncertainty, stagnation, exclusion, and what they desire most: growth, security, control. The unresolved question is not whether financial innovation will continue, but whether institutions will evolve fast enough to absorb its consequences. History suggests they rarely do. Innovation runs ahead. Crisis follows. Reform lags. Memory fades. Then innovation resumes. And so the story of financial innovation is ultimately a story of human ambition confronting human limits. A story that does not end with the invention of new tools, but with how societies choose to govern them, a choice that determines whether innovation becomes a bridge to resilience or a pathway to collapse, a choice that grows more urgent as markets become faster, more interconnected, and more opaque, forcing us to ask not what finance can invent next, but what it can responsibly sustain, a question that will only intensify as new markets emerge, old safeguards erode, and the distance between innovation and understanding widens, a widening gap that has always preceded the next reckoning, a reckoning that arrive not as a rejection of innovation, but as a reminder of its price, because every reckoning in financial history has forced societies to decide what kind of progress they actually want. The second act of financial innovation is never invention. It is accountability. When crises expose the dark side of new tools, the immediate reaction is often moral outrage. Speculators are blamed. Engineers of complexity are condemned. But history shows that innovation survives blame. What changes is the framework around it. Regulation expands. Transparency is demanded. Capital requirements rise. The system tightens until memory fades. The aftermath of the 2008 financial crisis illustrates this pattern vividly. Instruments that promised dispersion of risk were revealed to have concentrated it. Markets that promised liquidity froze simultaneously. In response, regulators imposed stress tests, centralized clearing, and higher capital buffers. Innovation did not stop. It migrated. Shadow banking grew. Fintech emerged. Risk moved again. This is the paradox of financial innovation. It adapts faster than oversight. Each rule reshapes incentives. Each safeguard creates new blind spots. Innovation thrives in those gaps. History does not show a final equilibrium, only oscillation. The most enduring lesson is that innovation is not neutral. Tools embed assumptions about behavior, trust, and power. Who can access them? Who bears loss? Who decides when they fail? Financial innovation redistributes not just wealth, but risk and authority. Understanding this redistribution matters more than mastering the mechanics. The future will bring new instruments, tokenized assets, algorithmic markets, artificial intelligence-driven finance. Their promise will echo the past: efficiency, inclusion, resilience. Their risks will rhyme as well: opacity, leverage, fragility. The question will not be whether these tools work, but who governs them when they do. History suggests that sustainable financial innovation requires three elements barely aligned at once: economic usefulness, institutional legitimacy, and social consent. Remove one and the system destabilizes. Add all three and innovation endures. If this journey through the history of financial innovation changed how you see new tools, markets, or crises, share what resonated with you. And if you want to continue exploring how finance evolves through ambition, failure, and reform, follow the channel and stay with this story, because innovation never ends, but history always returns to ask the same question. Not what we can build, but what we are prepared to live with.